So, thanks for everyone coming out. It's really a pleasure, not only for our speaker, who I'll introduce in just a moment, but we're very grateful to have Dr. Jay Cullen with us from the Institute of Corporate and Commercial Law at the University of Sheffield, who's an inspiration for a lot of colleagues here and has been like sort of talking with MILC and stuff and helping us think about sort of directions of how to study governance in the future. And then the man of the hour, we have Nathan Cedric Tankus, who's a he's from the Modern Money Network, where he's a research scholar, and he's been kind enough to come from the US and join us today. I agree. I'm with my daughter right now, just for those people who aren't on the camera. Is that it? Excellent. And Nathan's going to be talking about the spectrum of monetary sovereignty with us. Okay, so take it away, Nathan.
Thank you very much, John. Hello, everyone. It is an absolute pleasure to be here and to be invited to talk on such an interesting and exciting topic. Well, at least to me. The classic joke about economics was made by Lyndon Baines Johnson to John Kenneth Galbraith. He said, "John, did it ever occur to you that making a speech on economics is just like pissing down your leg? It seems hot to you, but not to anybody else." There's always a danger of that, especially with more specialized topics. But I hope at the end of my talk you can see the importance of a legal political economy analysis of international monetary economics to the world around you. But first, I should say a little bit about myself. I'm speaking here as a research scholar with the Modern Money Network. Our primary goal is to expand and promote the understanding of money and macroeconomics among grassroots organizations, policymakers, and the public at large. It may not be obvious why money is important to international public law, but I think it's crucial. Most discussions of international public law have money and financial relationships in their background. Further, as I'll discuss below, international public law structures the international currency hierarchy in all sorts of ways. On a practical level, discussions of free trade agreements and other such arrangements are always happening in the context of discussions of the quote-unquote special role of the dollar. The obvious question that emerges here is how does this dollar's special role, labeled dollar hegemony, how it comes about. And I think the answer is in large part the history of international public law and its ongoing structuring of these relationships. My point of view here is from an economic and legal school of thought called neo-Charlism. Thus, I should say something about what's relevant in this theory to discussing international monetary economics. The crucial starting focus for a neo-Charlist is an inquiry into what monetary objects and or biophysical resources are receivable in payment of non-reciprocal obligations, whether they be vergeld, taxes, fines, fees, or tort liabilities. Receivability is just a fancy legal term for what you can pay some obligation with. From there, the viewpoint expands to formally reciprocal obligations, from bride wealth and student loans to purchasing a MetroCard, or an Oyster card, as the case may be. Most histories of money, which are usually just histories of coinage, do not have this crucial focus, and thus don't give a clear idea of how the monetary system under discussion works. In other words, a neo-Chartist monetary analysis must begin with the receivability laws. While there's still a lot of history that has yet to be reassessed from a neo-Chartist point of view, I have confidence in the power and importance of neo-Chartism from my own explorations of the American monetary system from the 16th century to the Civil War. After examining receivability, neo-Chartists expand their focus to the process by which monetary objects are created. This is where a focus on monetary sovereignty takes place. By making its own IOUs receivable in payment of taxes and other obligations owed to the state, or private actors, a state can gain some degree of monetary sovereignty. The extent and power of that monetary sovereignty depends on the institutional structure of the economy and the international arrangements that the state in question has entered into. At this stage, it's important to note that it's receivability in general that backs money and not any particular amount of tax revenues. Thus, there's no monetary or tax constraint on the level or composition of spending. The constraint is, as I said above, the institutional structure of a national economy, including its institutional arrangements with the rest of the world. What I want to focus on is the constraints that emerge in the arena of international public law. In order to do that, though, I need to make some more general points about monetary sovereignty in a globalized world. Part of what I think hobbles the discussion of monetary sovereignty is that too often monetary sovereignty is treated as an either-or proposition. You either got it or you don't. This is odd foremost because such a Boolean point of view is becoming less and less popular about money itself. The perspective that has emerged from the last decade, and including getting more popular among mainstream economists, is that treasury bonds are quote-unquote safe assets in a similar way to central bank settlement balances or physical cash, as well as bank deposits for smaller actors. People like you and me, deposit insurance means that $70,000 in a bank account is perfectly fine, but for big actors who have $100 million that they need to deal with on a day-to-day basis, a bank account doesn't necessarily do the job they need it to do. And the way that it has emerged to talk about this is to talk about the moneyness of different financial instruments. In short, what is changing is the treatment of money as a noun towards a point of view that treats money as an adjective. If we see moneyness as a spectrum that different financial assets fall under, with some items at the top of the hierarchy and others closer to the bottom, why not approach monetary sovereignty the same way? A spectrum approach to monetary sovereignty also emphasizes the inherent interdependency of monetary sovereignty in a globalized world. When you take a receivability point of view in tandem with a balance sheet point of view, dollar hegemony and dollarization are one and the same thing. What I mean is that to say that the US has a number of corporations, countries, and households around the world who have dollar-denominated debts is to say that a number of monetary sovereigns, a number of foreign monetary sovereigns, have been curtailed in some way. This is even getting more mainstream reporting. Greg Ipe at the Wall Street Journal recently reported on how the rising dollar exchange rate and rising US interest rates are squeezing a number of countries whose corporate sectors have heavy dollar-denominated debts, thinking especially of Brazil, of Turkey, and other South Korea, other countries as well. It is the extraordinary amount of dollar-denominated debt which at once raises the monetary sovereignty of the United States above all others and pulls down the monetary sovereignty of other countries. This is what makes the US a currency hegemon. Thus, anything that leads to more dollar-denominated debts around the world strengthens dollar hegemony, and moves away from dollar-denominated debt in other countries weakens dollar hegemony. However, it would take a massive structural change in the way international economics works to transform the current pattern of currency debts, such that the US was no longer the hegemon. This also means, from a neo-Chartist point of view, reserve currency status is an effect, not a cause of dollar hegemony. Just as domestically, people are willing to save in dollars, even if they don't personally have many dollar debts, or they figured out a way to avoid taxes, they still accumulate dollars because they know that other people will accept dollars. And in that same way, international countries are willing to accumulate dollars because they know dollars are internationally acceptable. To push forward this analysis, I would recommend we expand our vocabulary beyond monetary sovereignty. The first term I'd introduce, which my colleague Raul Carrillo has emphasized recently, is the term monetary subject. Monetary subject is a way of speaking about the fact that individuals and legal entities, most prominently corporations, who are residents of a certain country, have all sorts of debts that are imposed on them, and such as taxes, and are existing in a certain area that most often issues its own currency, and thus they have a subordinate relation with the monetary sovereign. The monetary sovereign makes, another way of saying that is the monetary sovereign makes the rules, we just play its game. There are also monetary vassals, monetary subjects to one sovereign that with some degree of voluntarity pledge themselves to another by taking on foreign-denominated debts. This can be an importer who takes on euro-denominated trade credit, or a corporation seeking supposedly lower interest rates abroad. Finally, there are monetary tributaries, states who obligate themselves to another state as part of a treaty or in order to achieve an objective they think requires foreign currency. It is the monetary tributaries that are clearly the most important to understand from the point of view of international public law. Another thing that becomes obvious when you put on this analytical lens is that imposed non-reciprocal obligations are not just a matter of monetary sovereigns and monetary subjects. History is replete with examples of states imposing obligations on each other. from the Franco-Prussian War of 1871 to the Boxer Rebellion, to most famously World War I German reparations, imposed obligations on states have structured monetary sovereignty for potentially thousands of years. In fact, in some ways, the international currency hierarchy and its interdependent nature is most obvious in the case of reparations. The losing nations are under an additional burden of a foreign currency denominated debt, and the winning one have a new international backing for their currency. Public law, of course, does this in less overt ways, such as the Agreement on Trade-Related Aspects of Intellectual Property Rights, or TRIPS agreements. For countries that are, quote-unquote, intellectual property poor, TRIPS imposes a non-reciprocal obligation on them that they in turn impose on their populations to not violate international property rights regimes. Further, to get access to these properties, they most often need to pay in dollars. Meanwhile, while the monetary imposition of reparations is a historical topic of interest for understanding international currency hierarchies, monetary tributaries have not gone away. They exist to this very day. One radically under-discussed monetary tributary is the French colonies of Africa franc. The African Financial Community franc. I'm sparing you all an American attempt at French pronunciations, i.e. the CFA franc. Sometimes the difference between colonialism and neocolonialism is exceedingly thin. From the colonial era through the 1990s, the monetary union was pegged to the franc. It then became pegged to the euro in the transition to the eurozone. To this very day, the currency reserves of this monetary union are on deposit at the French Treasury. I should mention that 18 months ago, a book came out in French entitled Liberate Africa from Monetary Servitude, Who Profits from the CFA franc, co-authored by Kaku Nabokbo. Of course, focusing too much on a particularly glaring modern example of monetary tributary distracts from the main issue. Countries in intermediate situations where they're not so overtly pledged to another country or region, but nonetheless operate under geopolitical constraints, including agreements like TRIPS. We've gotten a lot of discussion of this recently in the past few years, as it's increasingly recognized that a number of countries escape dollar-denominated public debts, but have corporate sectors with particularly high dollar-denominated debts. This puts a lot of pressure on the balance of payments, since, as economist Philip Rezende has pointed out, in the Brazilian context, large foreign-denominated debts taken today are large flows of dollar interest payments tomorrow. If you forcibly converted monetary vassals into full domestic monetary subjects by redenomination, a fall in the exchange rate would reduce interest payment flows relative to foreign-denominated income coming in from abroad, including especially from exports. By this, I simply mean that when an exchange rate changes, you look at everything from a domestic currency point of view. Exchange rate movements have no impact on the size of Brazilian real debts, but do increase the domestic size of foreign-denominated income, or foreign-denominated debts. But redenomination or any other kind of legal change that impacts existing debts but brings the threat of geopolitical censure and retaliation. After all, the degree of monetary sovereignty is related to the degree of sovereignty itself. There are a number of different directions the lens of a spectrum of monetary sovereignty provides, but I will focus on one I think is the most relevant to an international public law audience: financial regulation and other financial policies in the context of international agreements and the geopolitical context. Clearly, this point of view posits that preserving and expanding monetary sovereignty is a vital and important goal for financial regulation. What policies pursue that end? Attacking the domestic creation of foreign-denominated bank deposits is key. Local deposit insurance systems can easily provide for domestic obligations, but being responsible for foreign-denominated obligations can cause problems. Additionally, not having domestic issuance of foreign-denominated monies can make it more difficult for domestic residents to quote-unquote run from the local currency. More generally, making foreign-denominated debts less domestically protected is an important avenue. On the flip side, making domestic credit more attractive is a way of competing with foreign debt in a certain sense. Philip Rezende, again, has written about how expansion of the Brazilian Public Development Bank's lending, Benendes, has displaced some of the desire to seek dollar-denominated loans. This opens the question of whether high local interest rates are really an effective way of defending the exchange rate, as is commonly believed, since potentially high local interest rates are leading actors to seek foreign-denominated loans abroad, which have balance of payments implications in the future. Another strategy would be lowering the priority of foreign-denominated debts in bankruptcy, as well as taxing the origination of new foreign-denominated obligations directly. The trouble, as I said earlier, is that the more a country attacks the legal enforcement of private foreign-denominated debts, such as through lowering its priority in bankruptcy, the more it risks the retaliation on the basis of international political arguments over expropriation, as well as other less overtly political mechanisms. Analyzing which strategies for defending or expanding domestic monetary sovereignty incur foreign political risks, and how dangerous various different foreign reactions are, is an entire area of legal political economy study of extreme importance. There's also an important fallacy of composition to avoid. While it may be the case that some developing countries can advance their monetary sovereignty sufficiently to do major political emancipatory programs, in our current geopolitical context, I don't think it's possible for all of them to do so without major political changes in the United States. Dollar hegemony is crucial to the U.S.'s role. Even if some individual suites of policies weren't seen as a threat, the U.S. would eventually intervene to disrupt the process of independent development if it got quote-unquote too far. To see both the possibilities and limits, I think neoliberalism provides the appropriate lens. The other important area for international public law is to examine agreements that are supposedly about free trade through this lens. There's already been discussions of how things like investor-states dispute settlement tribunals reduce sovereignty, but from this point of view, they also attack monetary sovereignty. As far as I've been able to tell, ISDS liability is all denominated in dollars. Thus, from a neo-chartalist point of view, ISDS is a powerful tool for preserving and strengthening dollar hegemony, and puts countries that otherwise have been able to avoid foreign-denominated debts in compromised positions. Even if the absolute dollar amounts have not been extremely large in relation to the size of the economies under discussion, the fact that any potential policy change can possibly incur dollar-denominated debts changes the policy arena markedly. On the other hand, the more governments try to resist the elements of multilateral agreements like TRIPS or free trade agreements with ISDS in them, in order to protect and advance monetary sovereignty, the more they risk being isolated internationally, which has its own economic problems, particularly around international supply chains, which I haven't discussed much, but would be happy to discuss more in the Q&A. Finally, and I really mean finally, foreign-denominated trade credit and medium-term sources of foreign credit may be necessary for ongoing trade relations. If that's ultimately the case, there are strong reasons to want a central clearing entity to manage these relationships and prevent the occurrence of monetary vassals. Examining the history of regional payments unions and clearinghouses from a neo-chartalist point of view is key to bringing that project forward. These arrangements were and are a form of international public law, but I think they've been relatively neglected, as money itself has been neglected. I'd like to end by saying that while I've pointed to a number of areas that need more work, particularly legal work, there has also been a lot accomplished, especially in the last decade, and the true power of neo-chartalism, in my view, is all the things that are ripe to be rethought in its context. Thank you. We'll get in order. I guess we can do it the old style, by hands raised.
It's more of an observation rather than a question.
The classic panel, the classic event.
Yes.
You should say it's more of a comment than a question. You just had to put just in that structure.
Okay, perfect. So my research field is ISDS, and I was really excited to hear that you put that in context. And my comment is this: that indeed I totally agree with you, and in fact, U.S. is the only country in the world nowadays that hasn't lost a case in investor-state dispute settlement. And in fact, there are cases under NAFTA, the trade agreement between Mexico, Canada, and U.S., that suggesting that if U.S. was to become liable under NAFTA, U.S. diplomats were threatening that they withdraw from NAFTA. So this is my comment.
Yeah.
And it's really interesting to hear.
Yeah, I think that's exactly right. And all these things that are formally legal, U.S. diplomats have threatened before. I mean, there's evidence, for example, that Saudi Arabia in the 1970s was threatened, that it warns that the U.S. would take it as an act of aggression to try to have majority buyouts of companies and to keep their investments in minority shares. And it's disputed how true that is, but it is the case that Saudi Arabia has not been buying out American companies, has been purchasing minority shares. And I think that you see a similar pattern with sovereign wealth funds around the world, especially when they deal with the U.S. context.
Thanks, Nathan.
Jay?
Yeah, I'd like to ask 2 questions, if that's okay, unless anyone objects. The first is more, I suppose, about the practical implications of the fact that the dollar has become, well, as we know, the world's reserve currency. And what are the democratic implications, do you feel, of the fact that you have all of these foreign institutions, I'm thinking particularly of the euro-dollar market, issuing liabilities in dollars, which can be, I suppose, must be underwritten by the Fed or the US Central Bank. And of course, during the crisis, we saw that unlimited swap lines were established between the major central banks. And what do you think the democratic implications of that are? And secondly, I was very interested in the taxonomy that you gave regarding the different levels of monetary institution, for want of a better phrase, between monetary sovereign, subject, vassal and tributary. And I was just wondering what a neo-chartalist viewpoint would be on the Eurozone, and into which category would those states fit, and are there even degrees between those states in terms of differences between which category that they would actually fit into?
Yeah.
So those are my questions.
Yeah. So I'll take the first big question. So I'll take the first question. The first question first. I think that I think there are large, obviously, democratic implications of the role of the dollar. Can you remind me of the second part of the first question?
The fact that essentially, if foreign institutions are issuing...
Oh yeah, the euro. So I would say the relationship to, I think euro dollars are more a problem for everyone else. They're a form of a dollar-denominated debts that others are taking on, and so that is more the form that they are the thing. Obligations like that are the thing that necessitate the swap lines. And I think that's one thing I could have mentioned. Swap lines definitely are an area that international public law needs to be commenting on, because central banks have unilaterally over the last decade taking a massive position in foreign policy without any of the normal foreign policy institutions having oversight. Like for example, what would if you started having a dollar-denominated debt crisis? What are the foreign policy implications of Turkey being offered dollar swaps by the Federal Reserve? And how does the national security state? What does the national security state have to say about that? So I think on the flip side of that, I think that because actually there is this dependence on the Fed, these things are more in the reach of the U.S. regulatory apparatus that are commonly known. If you look for, I think a great case study is Iran, and especially the beginning of Iran. Iran had euro-dollar accounts, and through threatening these international banks who also had relationships to chartered banks in the U.S., through threatening them, they were able to freeze Iran's euro-dollar accounts. So the idea that there is a common historical idea that euro-dollar is beyond the regulation of the state of the state or states, and I think that the historical evidence shows that that's overblown. But it's that regulation is centered in the role of the U.S. dollar in the U.S. On the second part, on the eurozone, I've been talking after talking. I did this talk at the University of Western England, Bristol, and talking with Daniela Gabor. It's nice in terms of having a full spectrum to have the complete opposite of a monetary sovereign, and so the opposite, which I think I would pick in line with Kako's book, would be monetary servant. or in monetary servitude. And I would say that very much, in that class, like that's like the ultimate tributary. The extreme form of a tributary is a monetary servant. And I would say that if formally, at least, all the members of the Eurozone are monetary servants of the Troika, and it's kind of the same thing because there's this international public law in the European context that has formed a center of power around the European Court of Justice and obviously the ECB, and these institutions that they are now in, because theoretically they all have a voice, means that in practice none of them have a voice except through their informal influence and ties to everyone who's at the top of these institutions. So, I mean, obviously, in practice, we've thought that that's Germany, and that Germany is at the center of that informal relationship. But it's important to note, because Germany does not have a formal role where they are the ones dictating, say, the ECB's policies, that there can be informal sociological things that can change. Things can potentially change, and Germany can, if it ran less of a current account surplus and ran a higher budget deficit, it could suddenly find itself in a situation where it was on the other side of Eastern European countries and some southern countries who are saying, you said this was what's good for the goose is good for the gander, and what you said was good for us is also good for you. And so I think that means that it's contextually difficult to understand which state is dominant. So in practice, informally, they're all subordinate, and it's just who's happened to be able to jockey for position at the highest institutions. And I mean, in some ways, there's a tyranny of structuralistness going on in the Eurozone that makes that more complex than dealing with other contexts where we have formal treaties and such that we can examine.
If we were going to move forward, if we come out of like public international law or some of these orientations, what would be like? So I think of like Christine Desan or Bob Hockett or people like that. Who would you recommend in a bibliography for us to sort of like gain some more literacy in this sort of direction?
I would definitely recommend Christine Desan's book. Certainly, also some of his papers, especially Finance Franchise, are useful in this regard. I think especially the discussions of international banks in that, where you have one licensed bank that is one member of this larger bank holding company, is an important element of this to examine. Of course, I would have to mention Michael Hudson, who his book Super Imperialism from the early 1970s is a foundational spot in this literature. And then he also has a technical book, which I think is called Financial Payments Flow Analysis, just a nice little 100-plus page monograph, which is a very technical analysis of balance of payments. There's disagreements to be had with pieces of that work and things that I would update for today, but I think that is certainly an important touchstone for where you start for this sort of international public law analysis. I also would recommend Charles Kinderberger's Financial History of Western Europe. It actually has some of the discussion of these more of the treaty-based relationships, has a decent discussion of Franco-Prussian War. I think there's a lot more to be explored in terms of treaties and how the treaties has structured international financial relationships. For example, I think we need a definitive database of all the treaties in the 19th century that involved committing a country to a foreign-denominated payment. But these are good places to start.
Well, can we give Nathan a round again?
Can I just ask one more question?
Go for it.
Yeah, and then we'll keep the questions going.
Oh,
Jay, why don't you finish it off
no.
first with the question?
I was going to ask, what are the implications, not necessarily of this paper, but of the things we've been discussing, with regard to the various proposals in relation to with structural reform of the banking system? I'm thinking about Morgan Ricks and the money problem and outlawing shadow banking, for example. But also the upcoming referendum in Switzerland on essentially full reserve banking.
I mean, we're,
Can we just give him a hand and then we'll keep it going? Sorry about that.